Put myself up in here. Hey, everyone. Welcome to Be the Boss of Your Money. This is the post-market show about personal finance, investing, about what's going on in the world of finance, of stocks, the economy. How does it affect you? And how do you make decisions to navigate all of this news flow coming at you and how to be better with your money? The fact is, most of the stuff you hear is irrelevant, just a lot of noise. We've got to learn how to tune it out. But don't tune me out. Oh, no. I'm giving you the skinny and what's really going on. I'm giving you the lessons, 32 years, coming up to 32 years in the business. And I share with you all of the lessons that I've learned along the way. Mistakes, challenges, how I've overcome them. We've got a lot to talk about. This is going to be a really good show. I'm going to run the intro, and then we are going to get into what's going on right now. The market started to rebound, but nope, not so fast. Didn't rebound. What happened? Here we go. Okay, and we're back. Thank you so much for joining me. My name is Mitch Goldberg. If you're just joining me now, you haven't missed a thing. We're just getting into the market. What happened? Where is the rebound? Weren't we supposed to have this great rebound after the big sell-off yesterday because stocks are still cheap, interest rates are still low, the economy is expected to get better as we get through the Delta variant surge? Where's the bounce in the market? Well, there's a few reasons why we didn't have such an extraordinary bounce today. And I'm going to be the only one who says this. This is a Be the Boss of Your Money exclusive. I'm glad we didn't have a big rebound today. Yeah, I mean, you heard that right. I am, let me make sure the mic is positioned. I am really glad that the stock market didn't have such a giant rebound. I can't stand when we have a really big down day and then followed by a huge update, because those huge updates, they just get repealed. They just go away and they kind of fade out the next couple of days. I don't want big moves back. I want the rebound in the market, providing we're done with the 3-week slide, about a 5% slide now that we've seen in the major averages. I'm talking about the S&P and the Dow, which are indexes. As you know, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Okay. So I know I kind of worked that disclaimer into it. I am so sly and I think I'm so sly and smooth, but really it's just like fumbling through the words of having to explain to people that you can't invest directly into an index. Like, you know, we all know that. If you don't know, now you know, but I have to say it anyway. So providing the slide is over, I don't want a quick rebound. And I know what you're thinking. Come on, Mitch, don't you want a really fast rebound and everybody will see the market go back up and they'll get their September statements, which are going to be coming out to you in about a week and a half, right? There's 9 days left in the month. By the way, today is the last day of summer in North America and in the Northern Hemisphere. And that kind of disappoints me a little bit, a little depressing. You know, it's not so much the cold, you know, the winter. I'm in New York, so we have cold winters. It's the getting dark outside at like 4:30. It's like, what is with that? What is with this changing the clock back an hour? I mean, just like leave it alone. I don't need it to get dark at 4:30. I can't stand that. I can't stand when I'm still at work and it's like 5 o'clock and it's pitch black outside. Who wants that? Anyway, I don't know if you feel the same way about it as I do, but I feel pretty strongly about it. If you have any questions about the content we're talking about today or personal finance questions, please ask in the comments. Words of wisdom, you know, words of encouragement, those are always appreciated here as well. It's actually a pretty nice day out, so maybe a lot of you are outside enjoying this, and you're going to be watching this in the replay. So if you're watching this in the replay, hit me up with your questions. I will see the alerts. I will get back to you. That is my favorite part of doing this whole live stream. All right, so let's talk about this. You know, the major averages closed down a little. The Nasdaq was up a little. But Dow was down. The Dow was up almost about, let's say, 300 points at its peak in the day. And it's like, wow, we're going to have this great rally. Then it faded away. Then the Dow started to go up again. But by the end of the day, it was just little by little, like a death of 1,000 cuts. And you're seeing the Dow go down a little every day. I mean, every couple of minutes, every day, every couple of minutes. Well, first of all, the Dow was down like 970 points yesterday, and it finished the day down about 600. So we saw a lot of the rebound happen already from yesterday. That's really what happened. It's not like the Dow closed at its low of the day yesterday and we get a rebound today. We had the rebound yesterday. And I think that's really, I think that's what's going on with it. I don't want you to read too much into this. Okay. The market's up. A lot of stocks have deteriorated. And finally, we're seeing some of the stalwarts of the market come down, although they rebounded a little bit today. But that's really, I don't think it's much more than that. Look, there are some big picture items here. Yes, we can't dispute how big the tapering is that the Fed's going to do. You know, the Fed buys bonds every month, pumps liquidity into the market. But the Fed's going to start buying less bonds. They'll still be buying bonds, but the Fed buys, Federal Reserve, our central bank buys $120 billion per month of bonds. And we're thinking they're going to start cutting about $10 billion off that. So next month, well, once they start tapering, they'll go from 120 billion to 110 billion to 100 billion until they get down to zero. So that's going to take, you know, about a year for them to finally get out of buying bonds. And a lot of people worried, well, that means, you know, what's going to happen? Like the economy and the stock market has to function on its own. Yeah, that's right. It's about time. We need the stock market, especially the stock market, to find its true equilibrium so that we can start a new bull market rally, but build it on a solid foundation, not just on the endless fluff from the Federal Reserve. Don't get me wrong. I'm glad the Federal Reserve did what it did to help the economy get through the COVID, recession. I don't want to say to get through the COVID pandemic because it's still ongoing, but the real heavy duty economic shutdown part of it in 2020, that's over. The Fed, Congress, trillions of dollars have been thrown at the economy, and we now have to let things go on their own. And as far as the Delta variant goes, you've heard me say this before. Something close to 70% of all adults in the United States who are eligible for a COVID vaccine have gotten at least one jab. Probably close to that amount, 65% plus, are fully vaccinated. More people are getting vaxxed every day. And unfortunately, more people are getting COVID every day, the Delta variant. But most people get through it. I'm not making light of it. I am totally pro-vax. I am vaxxed myself. My whole family is vaxxed. But as people get the Delta variant, they get past it. They have an immunity to it. I'd rather you have an immunity to it because you got the shot as opposed to actually getting COVID. But hey, listen, I can only control what I can control. I can't control other people. Okay. And I'm not in the business of controlling other people, nor do I have the desire. So anyway, I digress. But if you think about if you add up both the amount of people who've had COVID and the amount of people who are vaccinated, you are past, I think, the worst of it. Okay. So the economy starts to get back on track. There's a lot of fear now. People don't want to fly. People don't want to go to restaurants, things like that. But once we start getting past that, I know we've been saying once we start getting past that, we've been saying that for over a year now, a year and a half. But we did start to see what it's like when people get past it this past spring and summer. And you saw how well jobs creation did and how well the economy did. We'll get that again. That's why you don't want to give up on cyclical / industrial / financial / energy and materials, economically sensitive stocks. All right. So that's my story. I'm sticking with it. I was talking to someone and we're talking about the market and I've been saying this for a while. I think the S&P 500 could go down, but you could still make money on stocks. The S&P 500 is simply a reflection of how the biggest stocks in the index are doing. And you know who they are. It's Facebook, it's Amazon, it's Apple, it's Nvidia, it's Google, Microsoft. So if they hold up, that'll help the major averages hold up. If they go down, then the major averages will go down. But it doesn't mean that you can't make money in industrial stocks or energy or other economically sensitive parts of the market. You just won't know it by looking at the S&P 500, because S&P 500 is it's a market weighted index. So the biggest companies have the biggest impact on the index. Again, that favors the screen stocks, work from home, stay at home, tech stocks. Okay. We talk about that a lot here, by the way. So that's what's going on. That's why we think it's such a big rebound today. But I don't look into it any more than that. Evergrande real estate in China, same as yesterday. What I said yesterday, and I'll show you this. I had an appearance on TV yesterday on News 12, Long Island, New Jersey, Hudson Valley, in the New York metropolitan area. Okay, the New York City area. What I said is the only contagion that I see from Evergrande is that Chinese investors who may be getting hit with margin calls or have to raise cash, they're selling what they could, which is European and American stocks and crypto. And that's why you're seeing these particular assets drop. That's the contagion from Evergrande. That's not the contagion like collapsing economies, that it's going to cause a problem with our banking system and now our economy is going to have to be bailed out again. That's nothing like that. People compare Evergrande Realty in China to our Lehman Brothers moment in America, and it's not the same. I think that problem with Evergrande goes away. I think China will do what they have to do to limit contagion. And it'll be something like when the U.S. debt was downgraded, or we were used to be worried about Brexit, and then we were worried about Grexit, when the Greek economy was going to fold and leave the European Union. And so many other calamities that we've seen over the last, 11 years or so, which were all supposed to end the world as we knew it. And all they did was become an interruption and an opportunity for investors to invest. And we could have another big correction. We could. It's going to suck if we have it, because when you're going through the correction, it feels really bad and it feels like you'll never get through it. That is when I will earn my... When we do have the next big correction, whether if we're beginning now or not, that is when I will earn my fees as a financial advisor by showing and demonstrating to clients that they are in a portfolio that they could hold through bad times as well as good times. I've said this before. I want to say it again. It's worth repeating. I'm not here to build bull market portfolios. I build all-weather portfolios. The idea is to go up to find out what a client's maximum threshold is for loss, for pain, and take the risk metric of their portfolio and not quite get up to that level, but a little bit lower, and don't exceed it. And that's what keeps a client in for the long term in the market. It's not so much as having the highest return portfolio. It's having a portfolio that a client can stick with over the long term, because time in the market here at Client First Strategy, okay, is more important than timing the market. I always like to ask, what good is an investment portfolio if you can't stick with it? That's why I manage risk. The returns take care of themselves. So Disney, let's take a look at the market and what happened. I'll just show you this real quick. I want to do a share screen. Share screen. Let's see. Share system audio. Screen 2. All right. And let's put that up there. Let me move this up a little. I'm not sure how this is going to come out. Hopefully we can all hear it.
The bottom fell out.
Stocks plunged into the middle of the day.
And it freezes. I've got it
down almost 1,000 points.
Financial advisor
That was
Mitch
me yesterday.
Goldberg watched the carnage on Wall Street as U.S. stocks were slammed.
I don't think it was my best angle.
Over a $300 billion debt crisis with Chinese.
Am I really that fat, or is it just because it's a bad camera angle? Tell me it's a bad camera angle, because I look
for the S&P
really
500 and the Nasdaq
fat,
since
and
May.
I felt guilty while I was eating an ice cream sandwich last night before bed.
In July, which finished down at the
that's my favorite kind of
Monday,
sandwich, ice cream sandwich.
Points.
Okay, so the Dow was down yesterday. See, down 614.
Wharton from checking her portfolio today.
Let's skip this a little bit. Skip this a little bit.
By concern over
here I am over here.
This is not the time to worry.
For most people, this is a non-event. The Evergrande real estate debacle, it's an international non-event, in my opinion.
I hope you could hear that.
In the end, should a big market dip like we saw today keep you up at night worrying about your portfolio?
Did you hear that? Is that better? All right, we'll get rid of that. All right, we'll just get rid of that. So yeah, so that was an appearance. I've had a few appearances. I had one last week also about college funding, student loans, things like that. People wondering if Biden's going to do something about forgiving student loans. And my advice to people is, when the forbearance ends on January 31st and February 1st of 2022, you have to start paying back your student loans. You better do it. Don't wait for Biden to wave a magic wand and make your student debt go away. I don't see that happening. And plus, with the big priorities of infrastructure and spending packages and national debt showdown and all these other big things, debt ceiling showdown, I don't think waving away the student loan debt is very high on the list of priorities right now for the Biden administration. That's exactly what I said last week on News 12. Keith is out there. Great advice always, Mitch. Love the way you put it. Thank you. Keith is also a financial advisor in North Carolina, and we've become good LinkedIn buddies, and we have just the utmost respect for one another, and friendship, just a good friendship. We're part of this little clique of financial advisors who are creating all kinds of great educational content on your social media. So check out that name, Keith Wilson, on LinkedIn. Give him a follow and tell him hello. Tell him I sent you. Okay. You're not going to get anything. It just sounds cool to say. Okay. Let's take a look at some of the big stories today. Let's go to screen 4. I'll pop myself up in the corner. All right. And so one of the main articles every day is market rebound attempt fails as Dow closes in the red. Okay, so we knew that was going to happen. Let me go back. We already talked about that. We talked about that like 10 minutes ago. All right, let me make the screen a little bigger so you can see it on your smartphone, because you're watching this in a smartphone, hopefully sitting in your backyard or something, or maybe you're listening to this in your car, or playing it in the background in the office. And I do present this live stream as if you were just listening, not necessarily watching it. But the Dow off 50, Nasdaq up 32, S&P off a couple of points, 8/100ths of a point off, big deal. Okay. Oil was up a little today, and that's one of the things I pointed at yesterday. And the U.S. Treasury yield, the 10-year Treasury, was up a little bit. The yield, the flight to safety yesterday wasn't really evident. Like, I think we didn't see a huge bid come in for U.S. Treasuries. That's usually a flight to safety. When people are worried, they go into Treasury securities, they buy gold, and they sell oil. Oil held up pretty good yesterday. It was up today. Oil. The price of oil has been holding up very well. The oil stocks have not, which is why strategists say oil stocks, the equities, like, okay, they have a chance to catch up now because oil never really came down. And there's still some supply issues from Hurricane Ida as well. All right. So the flight to safety, the yen was up a little, the dollar was up a little bit. But, it's not so much that people were panicking and going into a flight to safety. It's just that people raising a little bit of cash. People take a look at their asset allocations. They come back from vacation, end of summer. You go out of Labor Day, and you come back and you look at your allocation and go, I was supposed to be 80% stock. Now I'm like 95% stock. I've got to rebalance. What does that mean? You're going to sell stock until you get to a proper allocation. And it's not just individuals like us who do that. This is something that, institutional investors do. Your mutual funds, your insurance companies, even your hedge funds, your college endowments. These institutional investors are doing the same thing. In fact, they're more strict about it than most individuals are. Okay, so let's take a look here. The Russell 2000 small cap index was up a little bit. That was the biggest loser of the day yesterday. It was down about 3%, but it rebounded a touch today. Okay. Big story of the day. Let me pop this up. Is the Fed will likely wait until November for its taper announcement. So here's how it's going to work. The Fed is having the Federal Reserve, the FOMC, the Federal Open Market Committee. That's the members of the Federal Reserve who meet every 6 weeks, and they talk about interest rate policy, Fed policy, what they're doing to either stimulate the economy, create more dollars, shrink the amount of dollars that are available, bank regulation, and investors watch what is said and done in this meeting like a hawk. We don't get the minutes until a few weeks later, but some of the meetings, not all, most of them, the chairman of the Federal Reserve, the chairman, did I say it like that? The chairman, Jerome Powell, who's currently the chairman of the Federal Reserve, he'll give a speech tomorrow at about 2:15, 2:30 tomorrow, because this is a 2-day meeting. So the FOMC was today, and it'll conclude tomorrow at about 2:00. And he'll talk about what the Federal Reserve sees as, what they see in terms of economic strength, inflation, what they're looking for. Is there too much inflation or too little inflation? I think most people agree now there's a little too much inflation. The Fed's, maybe will use the word transient, so they still think the big push in inflation is going to go away. Price of lumber was up to $1,600, and now it's down to $400, for example. Anyway, so one of the things they'll talk about is this bond buying program we spoke about at the top of the show. So the Fed's going to say, we're talking about tapering, reducing the amount of bonds we're buying every month until we get to zero. And then they're going to announce, maybe not tomorrow, maybe the next meeting, and they'll say, by the way, which is the next meeting will be, early November. I have a schedule of when the meetings are, but I'm just looking at it now, and it's not really that relevant right this moment. And then November, they'll say, now we have a firm date. We're going to start reducing our bond buying by December, maybe January, maybe December. I don't think the street investors really care if the Federal Reserve starts tapering in November, December, or January. We know it's close at hand. What we want to know is, what are the conditions that would get the Fed to keep buying bonds, or buy more bonds, or decelerate their bond buying even quicker? And these are the kinds of things that investors are watching for, because after that, the Fed, the next step after tapering is taking a look at short-term interest rates, like the federal funds rate and the discount rate. And then the Fed could start to raise those rates. And that starts to take liquidity out of the market. And I think that's really a lot of the trading today in the market, the downside in particular of the last few weeks, is being driven by investors who are worried that higher priced, highly valued stocks don't do as well typically when interest rates go up and liquidity comes out of the market. When interest rates go up, stocks with high PE multiples, their future earnings, when discounted to today, are worth less. It's how the math works. Therefore, you've got to mark down your high flying stocks. You've already seen the highest flying stuff come down, SPACs and crypto. And that's really what's going on in the market. Is this a death knell for the market? And like we all have to get out and brace for some kind of nuclear winter? I don't think so. Now, if it happens, I think for some investors, it'll be a good thing, especially if you're young and you're in the accumulation phase of life. For investors who are older, well, hopefully you have already done your due diligence and you have your asset allocation. So you're not risking too much. Because even if you're 70 and somebody who's watching this is 80 and saying, screw you, Mitch, what do you calling me old? You know, like I realize that people in the 70s or 80s have more vitality than ever. I mean, I have someone very close to me who turned 86 today. I already called him this morning to wish him happy birthday, and he is one of the strongest, sharpest people I know, and he still drives at night. So that goes to show you. But even if you're older, you still have money in stocks because there's still inflation, there's still growth that you're looking for. It's just you have less of it. Okay. That's about it. Let's keep in touch. If you have any questions, concerns, comments, let me know. I'm happy to address those. Okay. And I think that's it. I'll be back tomorrow. And I want you to all have a very good night and enjoy the last few days of summer, because tonight at midnight is the autumnal equinox. So happy harvest. Oh, John is out there. Thanks again, Mitch, as always. John, thank you for your support. You are a good friend, and you're very welcome, sir. Thank you. I'll speak to you guys soon.